Good evening. It's Saturday, February 3rd. My name is Dave Coker, and this is Talking About Finance. And hello there, seekers of cash flow. Honorable men and women who want to pursue their destiny to get rich. And we know one way, the only way to get rich, slowly, certainly, is to invest in assets that pay us to own them. Compared to the popular indexes pushed by gurus, self-appointed gurus near and far. Sure, you invest money, but what will the money be worth when you need that money? Index drops are more common and more substantial than what the gurus suggest. In spite of what the gurus say, you have no idea. The index could be higher, the index could be lower. You have no idea where it'll be. And neither does the guru. Oh, and verities like stocks always go up or the game is rigged. Don't cut it. When you're selling your index at an 80% loss because you need the money. And more importantly, what can that money buy? You need to have cash in your hand now. Money that can be used in a variety of ways. To pay your rent, to buy your food, to get some clothes, to have some fun. To invest into more assets that pay us to own them. Ask a guru if they're financially independent. No, most are young people who just got into stocks a couple years ago. And many of those gurus I've come across don't have any formal education in finance at all. And they actually try to present this as some kind of edge. What in the hell is going on? It's rubbish. And your future is being bet on advice from someone with no education in the markets, someone with no real experience in the markets. It's just a bad bet all around. They don't understand finance. They don't know finance. A couple of years ago, they were likely into crypto or NFTs or some meme coins. Who knows what they were doing? And now they're into stocks. What will it be next year? Who knows? They certainly don't. So it's a wonderful evening to talk about finance. The S&P 500 finished up about 1.38% on the week. 5 sectors outperformed the index, with consumer discretionary at the top. 4 sectors posted a gain, but underperformed the index. And 2 sectors booked a loss, specifically real estate and energy. Curiously, in spite of all the noise, technology was only up about 24 basis points, 0.24%. Maybe that AI hype is losing its edge. The VIX traded up on the week to 13.85. It started the week at 13.26. The 10-year note closed the week at 14.02, down 0.1% on the week, and up 0.1% year to date. Oil closed the week at 72.37, down about 7.2% on the week, and up about 1% year to date. Oh, it was another week, and it was another Friday, and of course I bought Bitcoin. But directly on the UK exchange I've been using for maybe 5 years. I pushed it to my hardware wallet, as one does. Guys, I still haven't dabbled in ETFs, and I know I said this last week, but I got to think about it. Truth be told, I have no problem getting Bitcoin, and I'm getting a little uneasy at the idea of involving Wall Street too much into my Bitcoin stacking. Anyhow, let's take a look at what me and my buddies, some 50 or so finance professionals from all around the planet, talked about last week. Oh, and my manners. Let me introduce us. We are Global Wall Street. And between Telegram and our personal networks, on LinkedIn and WhatsApp, we know everyone, absolutely everyone in global finance. And this week we're reporting from Wall Street. We're reporting from the city of London. We're reporting from Chicago. We're reporting from Los Angeles, and we're reporting from Miami. We have people everywhere, absolutely everywhere that matters. So let's go. 7 slides for 7 days. And finally, you absolute total money freaks, Send me the energy. We all gonna make money. So much money. And first up is an interesting story. I've written an article. You can find it on the internet if you look for zombies. I think that was the title, Zombies Are Real. And the Russell 3000, it's an index of small cap stocks. When we look at this, we can see that the health that's reflected in the Mag 7, the top 7 stocks in the S&P 500, we don't see it in the Russell 3000 at all. We see zombie companies, and a zombie company by definition is a zombie company that cannot earn enough to service its debt. It's called a zombie because it's walking around, it's a member of the living dead. Once interest rates mean revert, its lifetime here and now with us is limited. And eventually it's going to die. What can happen to a zombie? It can go bankrupt, it can be acquired. Lots of things can happen to a zombie. But the point is, the economy isn't as healthy as you would think. A lot of these companies borrowed, and because they're small cap companies, they don't have the diversity of income streams to allow them to pay back, to weather economic storms, which high interest rates are, and to pay back their debt. So if they can't pay their debt, they've got a problem. And we're right back, and this is Games of Trades. You'll have to go look those guys up. The original source is BIS and FT. And it's interesting because the number of zombie companies is back to, as they're claiming here, back to dot-com bubble level numbers. It's really concerning. And here's another one that I wrote. I put this up on Medium, I think it was. I did it for my institutional clients as well as a flash. And you know, one thing I'm always curious about, I'm looking at high frequency data here. I'm looking at trades at 1 minute intervals. And you can see on February 1st, there was a spike in Meta's share price. And yet, Meta, the earnings, the Q3 2023 earnings, were reported after the closing bell. So the question is, who knew what and when? And again, this is something that you should be aware of when you try to trade or do anything high frequency. It's not always as easy as you might think, and especially as the gurus put it out to be. In other words, there are entities in the market that are well connected and know a great deal more than you do, unless you're well connected. And yeah, I got to be honest with you guys. I heard about this the day before. There was a lot of chatter in the city, and a lot of people were lining money up. I don't do stuff like that. I invest only for dividends, long-term holdings. Yeah, I had a good indication this was happening. A lot of my buddies claimed, and they were moving in hard. Of course, people like that, they don't buy the stock, they buy call options. Oh yeah. And I know some friends made serious money, thousands of % return in just one day. Absolutely incredible. Yeah, it's better for you just to buy dividend-paying stocks, sit back and watch the fun. Still, we know that most people won't obey that or won't adhere to that advice, even though it's in their own best interest. Why? Most people are stupid with money. Now, this is out of Morgan Housel's recent book, fantastic publication. And he's got a really good quote here about what people, you know, when they say they want to be a millionaire, what they really want. I shouldn't divulge anything here, but I'm already blessed in that regard. But when I was looking at this from a sense of not being too wealthy, not that I'm super wealthy now, but you know what I'm trying to say, I just wanted $1 million in net worth. I didn't want to spend it. I don't know what, I grew up really poor, so what am I going to spend it on? I wanted the security because I knew given $1 million in capital, I could put it to work at maybe 6-7% and generate, 60, 70, even more if I wanted to move down the credit quality ladder, more per year. Oh, and I should just mention in that point, yeah, I do, the bulk of my capital is out there in high yield debt, although I do have holdings in REITs. And yeah, there's a reason why my capital earns over 16%, because I'm moving down the credit quality ladder. Now, don't be worried about that. Don't listen to what these idiots say. Look up Michael Milken's work, and you'll see if you own a large enough portfolio of high yield debt, a sufficiently diversified portfolio of high yield debt, the marginal default rate is only incrementally above that of federal debt or the risk-free asset. Oh yes, that's totally true. I've seen the data. And still, we do know that people are really dumb with money. And here's one. Now, I wrote an article that was somewhat critical of Tesla. And boy, the hate was on. The Medium article, a couple people commented. I had to block a couple of them. They got really nasty, really quick. And then I got some private mail with the hate on. And here's one. He gave me his name, and I looked him up on Twitter. Oh, God bless you, dude. I don't know what to say. 100% in any asset is really not good. I'm a proponent of diversification. I have wealth in stocks, obviously. I have wealth in gold and silver. I have wealth in property. I have wealth in cryptocurrency. I have wealth in art. You just can't do it. You can't put all your money into any one thing. Dude, if you're listening to me, don't do this. I don't know about being down 82%. If you put your entire net worth into something, I would think after 5% down, you'd gap out, and that would be the end of that. Don't know what to say. Don't know what to say. You'll get a good tax write-off. And, I've made mistakes, and I've got the write-off, and I don't have to pay certain aspects of federal taxes for the rest of my life because I've got huge tax losses that I can write off at $3,000 a year. Thank you, Uncle Sam. Still, I don't know what to say. It's a very fascinating problem. But we do know a lot of people aren't really good with money. They don't think too well. And speaking of not thinking too well, this guy bought a strategy on TikTok, and here it is. All you got to do is buy a house, live in it for 2 years, buy another house, move into it, rent the first house out, and then if you read the thread, he goes on a little bit deeper. The rent on the first house is going to pay the mortgage on the second, and you repeat that, and in 10 years you got 5 houses, and then you're a multi-millionaire. Not so sure. I don't believe it at all. Lots of assumptions, awful lot of assumptions that you got to work in. And I bet they didn't assume, at least the thread I read was about a year old. I bet they didn't factor in increasing interest rates to see what the impact would be. Yeah, people are really dumb with money. God bless them. They just have to educate themselves. And that's why I write a lot of articles. I tend to write an article a day, sometimes 2 or 3. And you can find them on the internet. You certainly can find them on Medium, a bunch on my blog as well. Wait for the Substacks to launch and you'll be able to get them there. And I'm just trying to help people. I don't understand why people are so poor with money. What I suspected is because I grew up really, really poor. And when I started working in investment banking, I saw a way out and I seized that opportunity, kept living like I was poor, and eventually achieved financial independence. But yeah, I don't quite understand it overall. And still, you got to wonder sometimes what people are talking about. Now, I have no idea who this woman is. I don't really care. Crypto's become boring. I don't think so, lady. If you're holding Bitcoin, you got a sufficiently large position. When Bitcoin drops, and we're talking $2,000 or $3,000 a day, holy crap, does that portfolio swing? I don't think crypto's boring. I think she's referring to all these altcoins, meme coins, what we call shitcoins. They were never legitimate to begin with. Nobody should have paid attention to them to begin with. There's really only one, and it's called Bitcoin. Bitcoin's not boring, and Bitcoin is legitimate. Ma'am, take a look at what BlackRock, JP Morgan, all these different companies are up to with Bitcoin, and you will realize Bitcoin is legitimate. Yeah, I don't know what she's talking about there, though. Oh, yeah, but those 11 Bitcoin ETFs are doing quite well. And yeah, money talks, and journalists like this, she'll be off writing about cooking in about 18 months, or I have no idea. I don't think she's a finance person by any stretch of the imagination. And finally, we look at the adoption of Bitcoin, and there's a power curve that actually talks about the theoretical uptake. It's the solid blue line, the gently sloping up perfect curve. And what they're doing is they're looking at the non-address zero count according to the power curve. Some of the assumptions in this is flawed, but regardless, check this out. Left-hand side is the number of addresses, right-hand side is the price of Bitcoin. It's really fascinating to see how the price of Bitcoin tracks that non-zero address adoption curve. Really fascinating. And then you can see the number of non-zero addresses for Bitcoin. Now, that's a little flawed in many ways, primarily because what we're not looking at there is the number of holders. I'm on record as using a new Bitcoin address every time I buy Bitcoin, a new receiving address. So I'll show up there as a multiple of addresses where some other people who aren't like me will show up as having one address. So it's a little flawed that way. It gets back to the semi-anonymous nature of Bitcoin. And also another thing that's very fascinating is just that it seems to be behaving properly. It's not deviating sharply from the theoretical power curve. It's really fascinating. And of course, who put this out? Fidelity. Fidelity's moved into digital assets in a major way. They've got an entire division called Fidelity Digital Assets. Over 2,000 people last time I checked. Good research. Little flaws here and there. But it's no big deal. All right, guys, that's it for this evening. Thank you so much for dropping by. You're going to have a wonderful week. It's going to be fantastic. You're going to make buckets of money. My wife and I just went to the pub. We went to a new pub. Oh my gosh, was it rowdy? It was really good, I'm telling you. I'd like to go back there, but we might not get the chance, but not tonight at least. I'd like to go back tonight because that crowd there, my God, they were drinking heavy, and when we left, they were about 30 seconds away from liftoff. It was wild. All right, guys, take care.